Imagine a house, a beautiful home under the sunny Australian sky. Now, imagine that house is sitting on a time bomb, ticking away, and nobody seems to hear it. That's the Australian property market today. But how did we get here? How did the dream of homeownership become a financial trap for an entire nation? It's a story of greed, flawed policies, and a ticking clock that could change everything. It all started with a simple idea: everyone deserves a home. In the late 90s, Australia introduced policies to make this dream a reality. They made borrowing money easier than ever before. This wasn't just about helping people. It was about boosting the economy, and it worked a little too well. Banks started handing out huge loans, sometimes for more than a property was even worth. This flood of easy money created a feeding frenzy. Property prices didn't just rise, they skyrocketed. What was once affordable became a luxury, and a new term entered the Australian vocabulary: negative gearing. This tax loophole turned property investment into a national sport. Investors could buy properties, rent them out for less than their mortgage payments, and then claim the loss against their income tax. It encouraged speculation, pushing prices even higher and locking out first-home buyers. For 2 decades, the music never stopped. The economy grew, people felt wealthy because their homes were worth a fortune on paper, and the government celebrated. But beneath the surface, the foundations were cracking. Household debt ballooned to become one of the highest in the developed world. People were taking on mortgages so large that even a small increase in interest rates could spell disaster. This is the turning point we're at right now. The Reserve Bank of Australia, after years of keeping rates at historic lows, has been forced to hike them aggressively to fight inflation. Suddenly, that cheap money isn't so cheap anymore. Every rate rise is another squeeze on millions of households, pushing them closer to the edge. The consequences are starting to show. We're seeing a surge in mortgage stress. People are cutting back on everything, from groceries to healthcare, just to make their repayments. Some are being forced to sell their homes, often at a loss. But this isn't just about individual hardship, it's a systemic risk. If enough people default on their loans, it could trigger a chain reaction, threatening the stability of the entire banking system. Think back to the 2008 global financial crisis, which was triggered by a housing collapse in the US. Australia dodged that bullet, but the patterns are eerily similar. Our market is arguably even more precarious now, with higher debt levels and more extreme valuations. We've had warnings and failed attempts at reform for years, but the political will was never there. The property lobby is powerful, and no politician wanted to be the one to pop the bubble. So what does this all mean for you? First, understand that high property prices don't equal a healthy economy. They often signal massive debt and risk. Second, the policies that created this boom, like negative gearing, have made the market fundamentally unfair, benefiting investors over ordinary people. And third, this isn't a problem that will fix itself. The interest rate hikes are the trigger, and the bomb is the mountain of household debt it's set to detonate. The Australian dream is on life support, and the question is no longer if the bubble will burst, but when, and how badly it will hurt when it does. This isn't just about numbers on a screen, it's about the future of a generation. What happens when the ticking stops? Thanks for watching. If this video gave you a new perspective, hit that like button and subscribe for more deep dives into the issues that matter. Stay informed and stay safe.